Hello, we will be doing our presentation on Netflix Incorporated, the world's leading internet streaming entertainment service. We will first be introducing what a corporation is, its key characteristics, and introduce the incorporation process. After, we will take a look at two documents, the Articles of Incorporation and an Asset Purchase Agreement, and how they relate to Netflix's area of corporate law. To start, a corporation is a legal entity that is separate and distinct from its owners. A corporation has 6 elements that characterize the entity, including a legal personality, unlimited life, limited liability, transferable shares, delegated management, and double taxation. To start, a corporation is a legal personality. This means it is considered a separate legal entity conducting business in its own name. Therefore, corporations may own property, enter into binding contracts, borrow money, sue and be sued, and pay taxes. A corporation is owned by stockholders and managed by employees. The sale of stock, death of a stockholder, or inability of an employee to function does not impact the continuous life of the corporation. Its charter may limit the corporation's life, although the corporation may continue if the charter is extended. Next, it has limited liability. The liability of the owners and investors is limited to the amount of money they invested in the business and does not include their own personal assets. If a corporation gets sued, the owners and the investors are not personally liable. The business is a separate legal entity. A corporation has transferable shares. If an owner or investor no longer wants to be part of a corporation, they can transfer their shares to someone else with little effect on the business. Transfers happen either through a public stock exchange or through private transactions for non-public entities. Delegated management is another key element. The structure of corporations include a board of directors and officers. The board of directors hire and monitor the officers and approve the decisions they make. The officers handle the day-to-day operations. Both of these groups split decision-making authority. Stockholders are agents for the corporation as well, but only if they are also employees or designated as agents. Lastly, double taxation. Larger C corporations such as Netflix have double taxation imposed on them. This means they must first pay income taxes on a corporate level for any profits they made. Then, they pay dividends to the shareholders who are also taxed again on a personal income level. Incorporation is the process by which a business creates a legal structure. It can be broken down into 3 parts: pre-incorporation, articles of incorporation, and bylaws. In just a minute, we will be looking at an example of what the articles of incorporation look like for Netflix. So before Netflix could be incorporated as a business, they had to go through a pre-incorporation phase in which the idea is given legal form and legitimacy. Some promoters may even find it beneficial to enter into a pre-incorporation agreement that sets forth their understanding and agreement about the formation of the corporation. To be recognized as a corporation, a business must file an application with the Secretary of State and be approved. Along with the application, an entity must include the business's articles of incorporation and pay an incorporation fee. Once an approval is received from the state, the corporation must develop its bylaws. The bylaws are the rules and guidelines for the internal control of the organization. In general, the bylaws are adopted by the board of directors and outline the rights and duties of shareholders, directors, and officers of the corporation. They are considered to be contractual agreement between the members of the corporation. The bylaws usually contain provisions for the regulation and management of the corporation. Reed Hastings started Netflix as an online DVD rental company. Fun fact, Netflix's name is a combination of the word internet and flicks, as in movies. So with this model, customers could go online and choose what DVDs they wanted and have them mailed to their house for a per rental fee. This was great for users that did not have a rental store near them, putting them in direct competition with Blockbuster. In fact, Blockbuster had the chance to partner with Netflix and passed. It eventually go bankrupt, leaving the market open for Netflix to expand. Soon, Netflix adopted subscription services for a low monthly fee. That fee has increased over the years, and more titles and licensing became available, and they expanded their online streaming services. Netflix streaming services now constitute 15% of the world's internet bandwidth. Today, they have more than 151 million paid subscribers in over 190 countries and bring in a revenue of just over $6 billion a year. All this wouldn't have been possible if they hadn't filed their articles of incorporation with the Secretary of State. The articles of incorporation are the charted documents of a corporation. For this article of incorporation, Netflix decided to file an application for the incorporation in the state of Delaware, as most corporations do, because of the state's friendly corporation rules. In Article 4 and 5, Netflix delineates how the corporation is to be managed by the board of directors and what decisions they must make with the consent of the shareholders. The board is expressly given the power to amend and repeal any of the bylaws with a majority of the whole board. Article 7 goes on to state that the directors are not personally liable to the corporation or the stockholders unless they breach their fiduciary duty, acts on bad faith, or engage in acts of personal gain. In the last article, Article 8, Netflix reiterates its right to change and amend the article of incorporation prescribed by the rules and laws of Delaware. Now that we've seen how Netflix got started with its articles of incorporation, let's take a look at a type of transaction they would engage in as a business, an asset purchase agreement. When Netflix started streaming movies online, they originally only purchased television shows and movies from other businesses who held the copyrights. However, that gets expensive when paying for licensing. Netflix alone paid $100 million to stream the television show Friends. With the cost of licensing and competition for original content going up, Netflix started producing their own in-house selection of entertainment with popular titles such as The Orange is the New Black, Stranger Things, Extraction, and Murder Mystery. Recently, Netflix has lost the licensing from several companies, and in the next 2 years will have lost almost 25% of its content to other companies who have started their own streaming services, such as Disney Plus, who has already pulled its content from Netflix. With a rush to find well-known titles for customers, for streaming services, other ones have built on the same properties as other familiar shows, films, and franchises. Amazon recently paid $250 million for the rights to produce a Lord of the Rings show, and Disney Plus purchased Marvel, Lucasfilms, and Fox's assets to be able to stream The Simpsons. Now Netflix is looking for new content that can match the same popularity. To do that, Netflix would want to acquire companies and assets that have similar products to the content they've already lost or are competing against. This next document is an example of an asset purchase agreement. An asset purchase agreement is an agreement between a buyer and a seller to transfer ownership of an asset for an agreed-upon price. This is different than a merger acquisition in that an owner can decide what assets are for sale and what is to be excluded. Another benefit of an asset purchase is the buyer does not assume the debts and obligation of the seller's company. However, it will be required to pay a sales tax on the goods it's purchased after, and money to be held in escrow, which we will talk about in just a minute. In this document, we are going to be examining an asset purchase agreement between Netflix and Sharkboy Comics. Sharkboy Comics owns several superhero and anti-hero comics that rival Marvel and DC Comics. However, they are only in print. Netflix wants to purchase the assets to the company to be able to create their own superhero franchises with full rights to them. They will be the only ones to be able to stream, trademark, and license any content. There are 4 key elements to any asset purchase agreement. The first and most important to any contract is who are the parties. In this case, it's Netflix and Sharkboy Comics. The second element is the agreed upon price for the assets. Netflix is agreeing to pay a total of $79 million for the assets to Sharkboy Comics. Also, as you can see, there are 3 subsections to the purchase price of the contract, but only 2 that are important in this case. The first is how much of the total purchase price will be held in escrow by the title company. When a purchase is in escrow, it just means that there is a contractual arrangement with a third party, usually a title company, who will receive and disperse the funds of the transaction. The money held in escrow is approximately 10 to 20% of the total purchase price, in this case, $12 million. It is put into a separate account set up by the escrow company. That money is a good faith deposit in case the transaction falls through because of the buyer's fault, in which case the seller would get the deposit amount. If not, then it is released at the end of the transaction as part of the purchase price. The next subsection lists the remaining amount to be paid unless any special provisions have been made. In this case, there is none. The third key element is the allocation of assets. Looking closely at the assets here, you can see that it gives an exact breakdown for each asset, including accounts receivable, equipment, furniture, and even trademarks and copyrights. This is a section where a seller can exclude certain assets if wanted. The last key element is the covenant to not compete. This is an agreement that the seller will not compete against the buyer in any similar business transactions. In this section of the agreement, the buyer can determine the terms of a non-compete agreement with the seller, including what the scope of the business is in terms of the transaction and for how many years the seller can't compete. Here, Netflix is asking that Sharkboy Comics not produce any motion pictures featuring any new or present comic books works for the term of 3 years. This is especially important for Netflix, who is looking to meet the competition on the comic book superhero category of streaming entertainment and doesn't want to add another competitor. The contract also defines liquidated damages for breaching the covenant to not compete. Here, Netflix is asking for $1.45 million per week in which or during the breach of covenant occurs. After that, the last thing to do is sign the agreement. Thanks for watching our presentation.